Hello, in this video I shall be discussing about portfolio revision as a part of security analysis and portfolio revision. Firstly, the meaning of portfolio revision. Portfolio revision is the art of changing the mix of securities in a portfolio. It involves a process of addition of more assets in an existing portfolio or deleting existing assets or changing the ratio of funds invested in the particular portfolio. In other words, the sale and purchase of assets in an existing portfolio over a certain period of time to maximize returns and minimize risk is called as portfolio revision. Need for portfolio revision. Portfolio revision may be done due to various reasons, some of which are stated below. Firstly, availability of additional funds. An individual at certain point of time might feel the need to invest more. The need for portfolio revision arises when an individual has some additional money to invest. Secondly, change in investment goal. Change in investment goal also gives rise to revision in portfolio. Depending on the cash flow, an individual can modify his financial goals, eventually giving rise to changes in the portfolio, that is portfolio revision. Thirdly, fluctuations in the financial market. Financial market is subject to risks and uncertainties, and an individual might sell off some of his assets owing to fluctuations in the financial market. Constraints in the portfolio revision. Firstly, transaction costs. Transaction costs are costs that are incurred while selling and buying of securities. These are expenses related to the transactions of the investor and the seller. For example, brokerage costs. Secondly, taxes. Taxes are required to be paid if there are short-term capital gain and long-term capital gain at different rates as per Income Tax Act. Statutory stipulations. There are legal restrictions on the sale of securities and assets that have been bought earlier. Some assets cannot be sold until the lock-in period expires. For example, some mutual funds have a lock-in period before which it cannot be sold. Time value of money. The value of securities and assets bought in the past gets affected by the rate of inflation, and the intrinsic value needs to be compared with the current market price. Availability of additional funds for investment. In order to change or revise the portfolio, additional funds may be required which may not be readily available at the time of revision. Next is a change in risk tolerance. The risk-taking capacity of investors may change with respect to time, and this change may affect the amount of funds that may be invested and the type of assets that form a part of the portfolio. Investors may be risk-takers or risk-averse. Thus, an investor who was a risk-taker earlier may act in a risk-averse manner and revise the portfolio accordingly. And lastly, change in the portfolio goals. Investments are made with specific objectives. The objective with which the investments are made may become redundant or change with respect to time. When the objectives or goals changes, then it shall lead to revision of portfolio. The portfolio, if was constructed with assets of short duration maturity as per a short time goal, then the composition of the portfolio would change if the goal gets completed or changes with some other goals. Next, we move on to portfolio revision strategies. There are two types of portfolio revision strategies: active revision strategy and passive revision strategy. Active revision strategy. It involves frequent or continuous change in an existing portfolio over a certain period of time so that the returns are maximum and the risks remain the minimum. The activity of revision of portfolio is carried out regularly. The basic objective is to beat the market. Passive revision strategy. Passive revision strategy involves rare or infrequent changes in the portfolio and if there is a need to change, then it is done as per predetermined rules. These predefined rules are known as formula plans. Thus, the revision is made as per already formulated rules. The formula plan shall be described in the upcoming part. Formula plans are certain predefined rules and regulations deciding when and how much assets an individual can purchase or sell for portfolio revision. Formula plans help an investor to make the best use of fluctuations in the financial market. One can purchase shares when the prices are less and sell off when the market prices are higher. In formula plan, the investor divide the portfolio into aggressive and defensive portfolios. The aggressive portfolio comprises of the equity shares or stocks, options, futures, etc. And defensive portfolio comprises of the safer and stable assets like bonds, debentures, mutual funds, government securities, etc. Formula plans facilitate an investor to transfer from aggressive to defensive portfolio and vice versa. The formula plans are used to help in making decisions for the future by exploiting the fluctuations in prices. There are three formula plans and they are explained hereby. Constant rupee value. The constant rupee value plan indicates that the rupee value remains constant in the stock portfolio of the total portfolio. Constant ratio value. Constant ratio plan specifies the ratio of the value in the aggressive portfolio to the value of the conservative portfolio. Lastly, variable ratio plans. In this plan, it is expected that the investor should sell stock and purchase bonds when stock prices rises. Similarly, when the stock prices fall, stock should be bought and bonds should be sold. In the concluding slide, we have the assumptions of formula plans. The first assumption is the stock prices move up and down in cycles. This means that there exists a cyclical movement of prices of securities in the market. A security should move up after it reaches a certain point downwards and vice versa. Secondly, the stock prices and the bond prices move in the opposite directions. It is understood that the bond prices and the stock prices are indirectly proportional to each other. That means once the stock prices rises and the bond prices falls and vice versa. Thirdly, the investors cannot or are not inclined to forecast direction of the next fluctuation in the stock market, which may be due to lack of skills and resources or the belief in the market efficiency or both. Thank you. That's all.